Your conference. Mute on.
The third in the four-part session in this year's webinar program. It is the successor to the Travel Law Conference that Baxter Travel Media and Hyphus Crozier Law has put on for a number of years. We hope with these programs this year to maintain the same standard as in the past with respect to the substance and the practical relevance of our topics and our message that we're going to deliver. We also hope to take advantage of the technological expertise of Baxter with respect to their webinar programs. This new format is an evolving process, so we're certainly inviting you to comment on how it's working for you, in addition to, of course, commenting on the subject matters that you'd like to see dealt with and how you feel we are dealing with the subject matters we've chosen. Certainly the technology is foremost in our mind in terms of your feedback. I'd also like to introduce you a little bit in advance to the two speakers today. Joining me in a few moments will be Howard Wall of Siebert Saranchuk LLP. That is a chartered accounting firm located in downtown Toronto. They're quite experienced in dealing with travel industry issues and clients. My name is Doug Crozier from Hyphus Crozier Law. Our firm is also located in downtown Toronto, and we also have had considerable experience with travel industry matters. I can also say that Howard and I, neither of us is exclusively travel industry in our clientele. We both have non-travel clients, and therefore we can bring a different perspective to the issues, in addition to having a bit of a familiarity with the nuts and bolts day-to-day issues that your industry will be dealing with. In terms of the substance of today's session, our objective today is basically to turn you all into Boy Scouts and Girl Guides. We want you to be prepared. For what? Well, the expected and the unexpected. The expected includes things that you know are going to happen, you just don't know when. Things like retirement and the need to deal with succession. Things like death, if death precedes retirement. Things like annual filings with government, be it tax-related or be it TICO-related. Those sorts of things that you know are going to happen, you just don't know exactly when. And also the unexpected. There's all sorts of things that may never happen to you in your professional life, but yet they might. The CRA audit is one obvious one that you'll be hearing from Howard about, or a visit from TICO or your provincial regulator in British Columbia or Quebec. A visit from the police, for example, with respect to travel patterns of your client. You may get an unsolicited offer to buy your agency, and we want you to be prepared if that happens. You may be hit by a lawsuit by a former staff person. You may be hit by a lawsuit from the company to which that former staff person has gone, with the other travel agency saying that you've stolen clientele and business from him. You may find yourself quickly in need of refinancing, either because an entrepreneurial venture went south or because you've been a victim of a fraud. You want always to be prepared to face those sort of unexpected developments so as to get off the mark as quickly as possible, to have access to the information that you need and be right ready and raring to go. So in short, there's a number of things that will, with greater or lesser certainty, happen to you in your professional and personal life. We want you to be prepared, or as prepared as possible, for those. Given the number of topics we want to talk about, our treatment will be, on each one will be fairly shallow, I believe, but we can always develop in the question and answer component or after the seminar any area that you want to develop further. Our counsel of perfection is probably going to be prepared for everything, anything and everything. That may be idealistic, but you've got to strive for as close to perfection in terms of preparedness as you can, so as to be able to minimize the risks, the consequences of the risks, and to improve efficiency. In doing so, we'll be touching principally on our Ontario experience. Both Howard and I practice in Ontario. But the topic today isn't really that provincial specific. Virtually everything that what we're going to say is going to apply coast to coast. Please forgive us if we refer to TICO. Just listen in your mind if you're in Quebec or in British Columbia to us naming your provincial regulator. When we say TICO, the applicability is still there. We're trying in our comments to touch the large multi-shareholder multi-jurisdictional company, and also be relevant to the one-off mom-and-pop shop, retail variety in a strip mall. So we're trying to cover a lot of territory, and we will now get underway. I guess one last thing before doing so is just in terms of questions, you're going to want to notice that you do have the ability to type in your questions. They'll show up in the bottom underneath Howard's and my lovely faces, and we will deal with them either on the spot if we have an opportunity to and want to integrate it into the presentation, or we'll set it aside and deal with it at the end of the session. So at that point, let's get underway with the financial side of things, and then it'll come back to me for the legal. My colleague, Howard Wall, who I'd introduced you to earlier on, will be handling it in two phases. He'll start off by talking about the CRA audit, which is one of those somewhat dreaded and somewhat unexpected events. And then he'll go on to deal with the internal audit that gives effect to what I said earlier on, that the idea of an ounce of prevention is worth a pound of cure. So I'll give you now to Howard Wall of Siebert Sarenchuk, LLP.
Good morning, and thank you for joining us at today's conference. My name is Howard Wall. I'm a partner at Siebert & Sarenchuk Chartered Accountants, and in this session, we're going to be addressing a number of topics related to the business's financial, operational, and succession issues. To begin with, as Doug mentioned, we're going to look at the tax audit, that really dreaded tax audit. You just received a letter that your company has been chosen for an income tax audit. Unfortunately, the tax man cometh. Don't point to the why me syndrome, as the audits are chosen based on models and the risk associated with those models. What to do now that the tax man has chosen you and wants to pay you a visit? The CRA has certain protocols in place that you need to be aware of, but one thing you have to understand is you have rights, and these rights are legislated. It is important that an initial discussion be undertaken with the tax auditor to determine the scope of their audit. Remember that the date chosen for the audit should be at your convenience, but of course, within reason. If you need time to get your books in order, don't be afraid to ask for an extension, and most often, those extensions are granted. The audits usually follow two paths. One is a general audit, and the other is a transactional. If your company has been chosen for a general audit, you are entitled to ask the auditor for a copy of their audit plan. This is more common for larger type audits, and larger audits usually they're split among three levels. There's the levels in excess of $250 million of revenue. There's then the basic file, which runs from $20 million to $250 million. And then there's the smaller files that revenue deals with, called just the basic type small audit. And with the smaller audits, the audit plans are not usually as focused and defined. If the audit is transactional based, you have to try to limit the scope of the audit by agreeing with the auditor for the information that they're looking for. Always ask if the audit can be conducted at your accountant's office. We like to see the tax man rather than at your premises. If the audit needs to be conducted at your premises, you should always designate a point person, a key person to deal with the auditor. Many questions by the tax auditors may be complex and or designed to confirm contentious issues that they've come across. So it's very important that you never guess at answers, and always instruct the point person in your office that if there is any uncertainty and any questions or implications, please, you should ensure your point person consults before they supply an answer to the tax auditor. Keep in mind that the taxman is not on your side, no matter what they tell you or how much they smile at you. Be polite, be courteous, but do not be liberal or generous with answers, and surely do not go on tangents. If your accountant is involved, Make sure that they review their own working papers. You should call them and ask them about that. And that they are prepared to deal with contentious or touchy issues that sometimes arise in the scope of their review of your work. And sometimes these are noted, but they're being buried in their working papers. So it's incumbent upon the accountants to ensure that they review their working papers during your tax audit. There's also the question of privilege of information, but these types of documents are usually solicited to client correspondence, and in most cases cannot be used by the tax auditor. It is critical to understand that information shared with your accountant in any type of correspondence is not privileged, and the tax auditor is free to use this information in correspondence between you and your accountant against you. Some key points to consider if the auditor is at your premises. Provide them with adequate and comfortable working space. Maintain a professional attitude. Keep the cursing down and have a courteous demeanor with the auditor. Never allow the auditor free access to your files. Free access to your correspondence or employees, but obtain information and the request for the information and only provide what is asked for. Do not allow them to go on fishing expeditions. They're not your buddies, not your friends, they're not your allies, and they're not there to help you. They have one task and one task only, and that's to seek out non-compliance with the Income Tax Act within your company. Where have you gone offside? So ensure that you do not provide more than is requested. If you think the question is difficult to understand, ask them to write it out and take the time to respond. And perhaps at this point, a call to one of your advisors, professional outside advisors, may be in order. If you're having difficulty with the auditor, you have the right to contact their supervisor if there's any dissatisfaction with the conduct of the auditor. Then the next process is what's called the Reassessment Proposal. And this happens prior to them issuing an official reassessment notice. Just about every issue that they propose is negotiable, and therefore you should always bend a little on the smaller assessment issues so that when multiple tax issues are up for possible reassessment from their audit, you may have some wiggle room for trade-offs. Ask the auditor to contact you with the issues before they send out a formal notice of reassessment, so you can have an opportunity to review and discuss these issues amongst yourself and or with your accountant or other advisor. Once a notice of reassessment is issued by the auditor, you have the right to ask for their working papers. You have a right to see why and how they've put together the information that they're sending you. And this will provide you with insight to their relevant finding of fact and law and possible irregularities. You should always take special care when you apply to a notice of reassessment, as the information contained therein can be used against you later on. There's a 90-day window to apply to this notice of reassessment, and this time frame is usually not extendable. So this is one time you cannot miss the deadline. In most instances, you should have a professional review these notices of objections and recommend that at this stage you probably should see your accountant or tax lawyer. Now that the tax man has left, let's talk about some other issues in tax legislation that are a little more beneficial to you as the taxpayer. Outside of a tax audit, a corporation may be assessed penalties for certain errors or oversights that have occurred in the daily course of business. And these have been caught, and the tax department has already assessed you for things like late filings or late monthly payroll remittances. We all know mistakes happen, payments are missed, issues are treated incorrectly, filings are past the due date, required forms are not filed. All of these can and do lead to penalties and interest. And for sure, you know that when you've done something wrong with the government, that they will pick it up and send you out a notice charging you penalties and usually interest. However, there is a light, and that light is called the Taxpayer Relief Legislation. And this allows the CRA to actually waive or cancel the penalties or interest that they have already assessed. For the CRA to waive these penalties and interest, you as a taxpayer must file a form, and the reasons for the issue that led to this misfiling or non-filing or late filing have to be detailed. The CRA will and does grant relief to taxpayers if the reasons for the missed deadlines or non-filed forms fall within 4 factors. The 4 factors are extraordinary circumstance, such as a natural disaster or a fire. The actions of the CRA, perhaps they mailed the notices to the wrong address, or they delayed in sending the notice, didn't give you enough time to reply, and therefore they assessed a penalty. Were you in fact in a position of financial hardship, and the reason you didn't file as requested or as necessary was you had this financial hardship? And another and last reason is any reasonable circumstance, such as a serious illness of the person responsible to file, and in fact a serious illness of a close relative. There are instances, and the CRA is very receptive, that if you can produce a doctor's note, and that doctor's note sort of ties in the misfiled information to the reasons as indicated on the doctor's note, the CRA is most accommodating if you can relate the two. It's not an onerous form, and all you have to do is lay out the circumstances, and it's very useful in those cases where you feel that you've been treated unfairly by the CRA due to the above noted conditions. It's interesting that this relief can be asked for going back as far as 10 years, but remember that when you open the door to the CRA past the statute barred period, they can now look at those areas as well. Another quite interesting area for the taxpayer, and to the benefit of the taxpayer, deals with those sleepless nights where you think to yourself, should you or shouldn't you? Did you tell this? Should you not tell this? Did you miss a reporting deadline? Should you tell the CRA? And it's called the Voluntary Disclosure Program. The Voluntary Disclosure Program is really a stress reliever for those taxpayers who have trouble sleeping at night due to the so-called oversight of income tax reporting. This VDP program is a tool that allows the taxpayer who has willingly and knowingly withheld or unknowingly and recently discovered unreported income, or has been negligent or incomplete in their income reporting to the tax authorities. This VDP is a most effective method to come clean with the tax authorities. The purpose of this program is to encourage taxpayers to come forward and correct inaccurate or incomplete information in their returns, to disclose information that perhaps was not previously reported, or to file forms that weren't filed, or generally to put yourself back on side with revenue or CRA. The incentive offered is quite dramatic, as the relief that these voluntary disclosure programs offer is relief from penalties and civil, as well as possible criminal prosecutions that could be imposed under the Income Tax Act. Another benefit is that the CRA may grant partial relief in the application of interest against a taxpayer in respect of tax years before or preceding the 3 most recent years of information returns that are required to be filed. There's 4 basic criteria for the VDP program to be applicable in your case. Number 1, the disclosure must be voluntary. They can't be chasing you. Two, the disclosure has to be complete. You can't pick and choose and decide what you're going to tell them under what circumstances. The disclosure has to involve a penalty, otherwise there's no point to the program. And the information must be at least 1 year past due. And this is so that you can't use this process to avoid penalties on a non-filing of a tax return because you were just away on the holidays and didn't get back on time. It's important to note that the CRA will not consider a disclosure to be voluntary, and therefore the program not applicable. If two basic criteria apply. One is that you as a taxpayer were aware or had knowledge of an audit investigation or other enforcement actions set to be conducted by the CRA or any other authority with respect to information that you are about to disclose to them. For example, you get a call or a letter and they're asking about payroll deductions at source that were not remitted. Once they open the tap and you're in their site, you cannot apply the voluntary disclosure. And secondly, and interesting, is that enforcement action relating to disclosure was initiated by the CRA on a third party or a person associated with you, such as one of your customers. For example, cash received from a customer is being investigated and traced back, and the trail leads to your office. Once you find out they're investigating that series of events that you were a part of, that disclosure will not apply. Therefore, it's incumbent on you to ensure they're not aware of any enforcement being taken or being proposed before making this voluntary disclosure. There are, interestingly, a number of recent court cases that have leaned in favor of the taxpayer, surprisingly enough, in some questionable cases where the CRA has come in to do an audit. Although it would appear that the circumstances surrounding this following story is that it would not meet the voluntary disclosure rules, the courts have narrowly interpreted the rule where the taxpayer cannot be under investigation for V to be successful. In other words, although it appears that the taxpayer has not met the criteria of being under investigation and therefore not eligible for the VDP, the courts have held that the lines of definition between what is being investigated and what is not allows the taxpayer some leniency. For example, the CRA has come in specifically to do an audit of HST, but the company panics as a result of this HST audit and decides to so-called come clean and report previously unreported tax deductions or remittances that should have been made that were not. The courts have held that the HST audit would not have zeroed in on the payroll of the taxpayer, and therefore the taxpayer's request for a voluntary disclosure is valid, and the related penalties and some interest can be waived if the VDP is accepted by the authorities. The use of this process can save corporations large sums of money related to penalties and interest. There's one interesting fact to this VDP, and that's it's not a get-out-of-jail-free card. You can't keep this in your desk and use it when the heat gets turned up by the revenue, by CRA. This program will usually only be allowed to a taxpayer on a one-time basis. Having talked about the CRA makes my mouth pretty dry. I just need a polygraph. Okay, now that we've talked about the external audit and tax auditors, let's talk about the internal audit. And the internal audit revolves around what's happening within your business. In every business, it's critical that your internal records are complete, accurate, and timely. Financial information is a tool that helps the business move forward, and any tool is only useful if it is applied in the right circumstances and is used according to how it is meant to be employed. Take, for example, the use of a business plan. In my experience, the one tool that is consistently neglected by the business owner is an effective business and marketing plan. Operating a business without the use of a business plan is akin to playing basketball without a net. Where are you supposed to direct your energies? How do you know if your forces are moving in the right direction? How do you know if you need to adjust your target? And in fact, what are your internal strategies to ensure that your business is moving in the right direction? Strategy is defined as the art of war. And each business is truly in a war and in a battle. This is one continuous factor that is definitely not an unknown in your business. You need every tool available to move your business forces up and over to the next challenge. Developing a business plan is key to your understanding of where you are, where you want to be, and what you need to do to get there. There's one thing you take away from today's session. Go back to your offices and look at your plan. If you do not have a plan, then it is incumbent upon you to sit down and develop it. A business plan does not need to be complex and detailed, but there needs to be a plan. This can take the form of financial budget, usually tied into a marketing and sales plan. Any one of these models helps you understand your business, from the revenue streams that you're trying to develop to the cost controls that are needed to be efficient in your daily operation. A business plan can be short-term, monthly or quarterly, annually, or long-term that carries forward over a, let's say, 5-year span. There are many steps and details involved in fleshing out a comprehensive and compelling business and marketing plan. And here are some general guidelines to think about as you get started or as you review your plan. Firstly, involve all of your management team in the process, including the accounting, financial, and any special advisors within your organization. Engage the best writer from your team and stay directly involved yourself. Do not delegate in preparing the plan. Emphasize that your extensive market research within your organization, your financial ability, and your management team strength should all be part of this plan. Keep in mind that you are usually writing your plan for two audiences. A financial partner will use it as a guide to investing in your business, and you will use the plan as a blueprint to launch and grow your organization. Be comprehensive, but concise when you lay out your business plan. Business planning is the focus that is required for a successful business. Put a plan in place, give it the continued attention it needs, and with this in place, your business has a strong opportunity to grow and become profitable. Whether it grows bigger and stronger obviously depends on many factors. However, the point is, without business planning, more likely than not, you have a good chance of ending up running in circles while your competitors are passing you by, executing their defined and measurable business plan. Part of today's session has to deal with the corporate audit, and basically, is your house in order? Do you have a corporate audit plan in place? A corporate audit is an examination of financial or operational procedures within an organization. Most people think of audits related to income tax. However, corporate audits obviously are much more than that. The audit process within a corporation is designed to ensure that companies are complying to the relative laws, that their internal defined ethical standards are being followed, and their processes are geared to follow management's vision and direction. A financial corporate audit is geared to the review of the financial practices of the company and a review of its financial, accounting, and reporting. There are great benefits to financial audits, as the focus is to see how and where the efficiencies of the company can be improved from both an operational and a cost perspective. To do this, there has to be a strong starting point represented by a complete and accurate set of accounting and financial records. These financial records and how they are designed are critical to a proper evaluation of the company's historical and present operational achievements and aid just dramatically in their continued growth and profitability. Most corporations employ a basic accounting model that produces relatively simple financial information, such as revenue and expenses and the resulting income. Yet most businesses are not simple and are not comprised of divisions, they are comprised of divisions, departments, revenue streams, cost allocations, personnel allocations, etc. To effectively have good corporate financial control of your accounting records, they should be streamed and designed to capture this information effectively and, more importantly, in a timely manner. Not only must your information gathering system allow for this to happen, but you, as management, you have to use this information as a tool to review those finance areas for efficiency, profitability, and growth. To understand the status of your corporation and its effectiveness in implementing its corporate strategy, needless to say, there must be a strategy. And as discussed above, to measure this effectiveness, there needs to be a measurement template. The measurement template should take the format of the business plan against which to measure your performance. The more meaningful breakdowns that are included and the more detail that is measured in your accounting records, the more useful this template becomes. There are few benefits to be enjoyed by a corporation if they do not monitor and constantly evaluate and update their business plan against their actual operating and financial results. Every company's corporate compliance should include a job description for every person on payroll. These job descriptions produce real and role is complete, it's operationally effective, and there's no duplication in their duties and activities by anyone else in the organization. And as well, it ensures the tie-in of the related paper flows is correct and well streamed. Have not been upgraded. You don't revisit them, and they're not amended to ensure continued efficiency, profitability that you're trying to maintain. More often than not, in most organizations, as people are added or businesses grow, systems and financial information is usually band-aid adjusted instead of revamped and reorganized. If you do not review in detail what your company has done in the past year and look at the resulting output of financial information as a tool for correcting what your future steps should be, you are definitely leaving many dollars of wasted costs and unnecessary operational procedures on the table. A corporate audit can learn from the processes used by its external auditors, folks such as I. When we do an external audit, we follow a defined, pre-planned, organized, risk-based assessment of the audit that we are about to commence on your financial records. Firstly, every member of the external audit team is required to sit in on an audit planning meeting. Similarly, each member of your organization needs to understand what the company's goals, objectives, and plan of attack that has been organized by senior management. The key to effective cost control is very often in the hands of your average employee who controls the largest burn rates of most organizations. Secondly, your external auditor looks at each area of the company's financial statement information on a line-by-line basis, and this is evaluated for risk and designated with a risk factor from low to high. Similarly, in your corporation, this model of risk assessment should be employed on a cost-by-cost, revenue-by-revenue basis to determine where the energies and effort of senior management should be directed. Your internal financial audit must commence with a planning meeting. Associated with various revenues. What cost of sales are we trying to achieve? And what should be our typical gross margins? What areas are we experiencing growth? Who in the organization is responsible for which tasks? Does everyone have a complete understanding of the company's vision? What funds have been allocated to which projects? And who is responsible for ensuring that there are no cost overruns in these projects? Who and how often are measurements to be taken to ensure compliance with management objectives? And importantly, has your company developed what are called KPIs, key performance indicators, which are to be used as a yardstick in determining whether daily or periodic objectives are being met? Is your business plan built first and the required staff then plugged into this model? Or is it the other way around? And if it is in fact the other way around, you may be wondering why you're spinning instead of growing. The operational audit plan must be laid out with each area of importance ranked so that appropriate staff members with the correct credentials are being used to implement the plan. The most effective way to review your organization's efficiency is sit with them. Sit with each member, with each group, with each department, and have an open discussion as to issues, inefficiencies, redundancies, and cost savings from their perspective. They're the ones, they're the frontline people, they go through this day in, day out to pay some heed and attention to what they have to say. Following which, a senior member of the team should review all of these notes and put together a master plan of action, taking into consideration the facts as they are and the required changes to be made to achieve the results which the management team desires to reach. To continue with the analogy with the corporate financial audit simulating external audit, once the management team has identified the risk, it's necessary for management to identify the processes that the company should undertake in order to mitigate the identified risk. The new standards in these types of audits sees the time devoted to the planning as the key to the success of the operational audit. Is at this planning stage where each of the key staff members share their thoughts with senior management to ensure that the direction and the issues to be addressed are relevant, critical, and will contribute to the overall growth and profitability of the organization. An operational audit has to be focused, defined, and the clear path of action laid out. It has to start with a plan and end with implementation. George Bernard Shaw said it best when he said, quote, "To be in hell is to drift, but to be in heaven is to steer." There's an interesting story biologists tell us, and that is if a frog is put into a pan of warm water, he'll contently sit there, even if the heat is turned on under the pan. And long, long before the water boils, the contented frog will be dead. The lesson here is if you continue doing what you have always done, while the environment around you changes, your chances of survival are minimal. Be aware and be a survivor. And as Doug had said, there's a lot of small sessions today, so this is the last of the financial and operational side, dealing with my part of it, dealing with does the corporate audit extend to a succession plan. There are many issues that a business person needs to focus on to ensure survival, profitability, and growth, and many do not pay attention to the ever-present issue of succession. Corporations, by their very nature, are ongoing entities, and by definition, survive the death of their shareholder. The issue here, however, is even though the corporation survived the death of the shareholder, is there a succession plan to ensure that the corporation will continue to grow after the death of its shareholder and continue as the exiting shareholder would have wanted it to be? More importantly, should the shareholder wish to leave or retire from the corporation, is there a succession plan organized that will ensure a smooth transition from the existing shareholder, either a key employee or designated family member? Succession plans can take many formats. They are sometimes referred to as estate planning. And this is to tie the succession plan from the shareholder to the corporation. There are many ways to structure an estate plan, and there are a number of alternatives that will allow for maximum tax saving on succession. But this needs to be organized, structured, and implemented. Currently, Canadian tax law allows for $750,000 capital gains exemption on the sale by shareholder of a qualifying small business corporation, and this can be achieved fairly easily with proper structuring and tax planning. Many business owners do not realize the actual current value or the potential realizable value of their business. They fail to take the necessary steps that will lead to a smooth transition out of their business and the benefits of a tax-free gain on their retirement, the sale of their shares, a reorganization, or an estate freeze. Another critical part of the succession plan entails a situation where you want to sell a part of your company or bring in an investor and take advantage of this tax-free gain. On the sale of 100% of your company, and perhaps ultimately your holding company, you may achieve a tax-free capital gain. However, this corporate structure may not allow a partial sale of your company on a tax-free basis unless changes are made to the way your operating company, holding company, and related shareholdings are structured. I recently met a new client who entered into a purchase and sale agreement of a part of their company, but the corporate structure was such that it could not personally take advantage of the capital gains exception, and so they gave up many thousands of tax dollars that they could have put into their pockets instead of the pockets of the government. Strictly and simply would have been different if the organizational structure was thought of in advance. Timing is everything, and many of these corporate structures and reorganizations depend on them being in place prior to any willing buyer being identified. This area of succession planning, corporate structure, and estate freezes should be reviewed with your professional advisor so that you can take every advantage available under the current tax law. More importantly, this should be done now. Doug, that sort of wraps up this particular session that I've addressed today, so it's over to you at this point.
All right, thank you very much, Howard. In his comments, Howard spoke about the need to get your house in order. My portion of the seminar dealing with the legal side of things starts with getting your corporate house in order. First area I'd like to talk about is the minute book for your company. Most people use a corporate vehicle for carrying on business. It's not necessary that the minute book be a formal purpose-built document that you can get from a variety of legal stationery companies. A 3-ring binder, a file folder will suffice. But let me use the term minute book regardless of how formal the document is. It can be maintained in your office or at your lawyer's office, but it's good to have an assembly of the key documents in one place so that you can put your hands on them on a moment's notice. Among those key component parts are the following 5 or 6 items. First, the Articles of Incorporation or of Amalgamation, which is the birthing document, the one that establishes the existence of the company, at least at a particular point in time. I distinguish that from the ongoing existence of the company, which I'll talk to in a moment. It's the place that identifies the types of shares that are authorized to be issued. If you have an investor comes along and wants to invest money in your agency and says that he's happy or she's happy to take preference shares as opposed to common shares in return, you can't just willy-nilly issue preference shares unless the articles have authorized them, and the characteristics of the shares have to be authorized in the articles. It's a key document. It's got rights and restrictions on what those shares hold. And sometimes in older companies that have been around for a period of time, the types of business that the company can carry on is restricted in the articles. If you're unsure about whether the articles are available, you can get a copy from the provincial ministry in your province. You can also get a certificate of status that confirms whether the company still exists. This goes to my earlier comment. Sometimes a company can be created and then through neglect on the part of the owners, lack of filing of corporate returns, may have found its existence terminated. You may be operating a company that no longer exists. Getting a certificate of status from the provincial government can put your mind at rest or confirm for you that it has ceased to exist, and you have to take steps to revive it. Second component part of the bylaws of the company, they establish the rules of procedure for the operation of the company. Not overly relevant if it's a one-person company or if it's a mom-and-pop shop, husband and wife owning the shares. Very relevant if it's a multi-shareholder company where there's a potential for fractiousness down the line. Got to know what the rules of the game are. Those are established in the bylaws. The identity of the officers and directors is the third component. You may, off the top of your head, say you know who the officers and the directors are, and who's the president, and who's the secretary, and that sort of stuff. But I ask you, can you prove it? You have it recorded as such in the minute book. The formal appointment signed by the appropriate people, be it shareholders for directors and the board of directors for officers. If it hasn't been documented, then you may be disseminating incorrect information. That information as to who the officers and the directors are has to be consistent between what you're telling the provincial ministry on the one hand, as is your obligation, and what you're telling TICO or the provincial regulator in your province of operation, and what you're telling IATA if you're an IATA-appointed agency. Another component of the minute book would be a shareholders agreement. That is a very relevant document if one exists. It's not obligatory, but once again, if you've got more than one shareholder, especially if they're not spouses or family members, potential for fractiousness exists, and the rules of the game that are established in general terms by the bylaws are more precisified, if I can use that word, in the shareholders agreement if such exists. The minute book would also contain proof of the authorization of resolutions that authorize dividends or management bonuses. If you are faced with one of those CRA audits that Howard spoke of, they may want to look to see whether there's a proper documentation of the payment of money from the company to its shareholders, to its officers, to its staff. That would be found in the minute book. If the company operates under a business name or trade style other than its corporate name, it has to register with the provincial government. A comparatively minor expense, something like $75 for a 5-year duration. In Ontario, it's called a master business license. But you got to do it. You've got to do it in order to conform to the provincial statute. In Ontario, it's called the Business Names Act. You also have to do it in order to pass muster with TICO. TICO does a particularly vigilant job of making sure that everybody that is licensed in the province uses names, trade styles, that are properly registered and for which there is a master business license. So if you've got to do it, you might as well do it and be ahead of the game rather than have to respond to a TICO request after the fact. Speaking of TICO and moving away from the corporate minute book, your license no longer needs to be on display in the office. Those of you who have been around for a while will perhaps remember you had to, at one point to have it on display. That's no longer the requirement. You do, however, have to have it producible upon request of any person. Not any government official, TICO official, just any person. So in theory, a consumer, a client could ask for proof that you're TICO licensed. So could a supplier. I suggested if you have to have it producible at any time, you might as well put it on the wall. If not right at the very front, then perhaps at the back, but then you know where it is and you're not in that situation that so many of us are, wondering where they've left the car keys. And if you're wondering where you've left your TICO license, that's not a good situation. Might as well display it. You also should be taking note of your filing deadlines with TICO. You have a renewal application that has to be filed. You have your Form 1s that have to be filed 90 days after your fiscal year end. Why not diarize that? diarize not only the 90th day, but diarize the 30th and the 60th day after your fiscal year end, so that you've got a bit of a heads up as to, oh my goodness, I've got 60 days to go, I've got 30 days to go, as the deadline reduces. That way you're not relying upon TICO reminders that may or may not come to your attention. Take on responsibility yourself. Has established that help to explain a variety of compliance issues. The other two provinces have similar, but you are well advised. I'd say, make yourself a pot of tea, get a cup of coffee, and wander around the TICO website if you're in Ontario. Take a look and see what they have suggested is the rule, the law. Remember, it doesn't, just because TICO says that's the law doesn't mean that it is, but chances are it's a pretty close approximation of what you need to do in order to comply. Take a look at the website and then compare what they say is the requirement with what your actual practice is. Same is true of IATA. Their website is of limited use, largely because the handbook and the compilation of resolutions is so imponderably dense. But still in all, you could profit from taking a look at what IATA says are the rules in terms of your relationship with it. You should also, with respect to IATA, as well as TICO and a whole variety of other things, keep your eyes open in terms of compliance. You may not be in compliance, and you may have gotten away for a number of years with minimal non-compliance with the rules of these regulators. But as I'm sure you told your kids when they were growing up, just because you can do something doesn't mean you should. Just because you have gotten away with something doesn't mean that you should, because there are potential risks. For example, if you have advised IATA that you have a security alarm system, if you've advised IATA that your safe is bolted to the floor, if you've advised IATA a whole variety of things, you may have been able to get away without actually doing so or having that security system in place. But in the event that you have a break-in and losses are incurred, if you have misled IATA with your filings, you may find that you lose the protection that the IATA resolutions afford you. And I ask you to ask yourself whether that minimal cost of compliance was worth the maximum consequences of an after-the-fact problem. Computer licensing, switching significantly here. We are all supposed to use computer software only that has been purchased properly and properly licensed. It is possible, as we all know, to make use of pirated or excessively duplicated software. You may be able to get away with that. The whistle may never be blown. But it's possible that a Microsoft audit may find you. And it's also possible when you come to sell your agency that the purchaser, as part of his due diligence, one of the things he's going to say is, prove to me that the software that you're using has been properly purchased and is not pirated, so that I, as a purchaser, am not going to run into a problem down the line. Indeed, even if you did properly purchase and have properly licensed your computer software in your office, I ask you, did you put your hands on proof right now? If not, that's one of the things that hopefully this webinar will bring you to do, so as to have the ability to answer that question with yes. Turning to tour operators for a moment, the selection of your suppliers. This is something that if you have fouled up in the selection of your suppliers, you may not be able to rectify after the fact. Compare that with the example I just gave of a computer license. If you haven't got it properly licensed and you find out about it, you can probably regularize it by making the actual purchase. But if as a tour operator you haven't done the proper job of selecting your suppliers, you may not be able to regularize things after the fact. And when I say tour operators, this also you, the tour operator, or the retailer that puts together a package, is not automatically responsible for the misdeeds of the suppliers whose products you put together. You're not automatically responsible for their misdeeds. You're not a guarantor of their services. But you have to be in a position to prove that you've done a reasonable job of metaphorically kicking the tires of the supplier? Have you made inquiries about their reputation with the local authorities if you're dealing with a different country? Have you dealt with tourist authorities in that jurisdiction? Have you determined whether the hotel, the bus operator is properly licensed in that jurisdiction? Because if you can't prove that after the fact, you may find yourself being brought to account for that company's errors or omissions, even though you didn't have any real ability to control what they did. If you haven't properly selected your suppliers, then you may well face the consequences. That sort of a policy is one that you should consider implementing. A lot of tour operators have their own checklists to go through when they go through the process of selecting their suppliers. They check things off. That's one way of making sure that they don't overlook something, and it also serves as an after-the-fact document that can be used to prove that they had done a legitimate, a reasonable job of selecting a supplier of services, and thereby hopefully get off the hook as far as being responsible for the consequences is concerned. That whole idea about a policy is the next general heading. You would have heard of FIPEDA, the Personal Information Protection of Documents statute that came in about 5 years ago. We are all by now obliged to have a privacy policy. Not everyone does, but we are supposed to. Do you? If not, you might want to get one. There are a variety of other policies that you can have that you don't have to have. With respect to human rights, for example, even if you don't have a written down policy, are you aware of the human rights proscriptions, what you can and cannot do in terms of refusing to do business with a customer, in terms of interviewing for a job candidate, what questions can and can't you ask? Ideally, you've got a written policy in that regard, and even if you don't have a written policy, are you at least aware of the shoals, use the title of today's seminar, that you can run afoul of if you're not careful. Sexual harassment is another area where a written policy may prove to be worthwhile. If you're a large company, a policy about personal relations between employees within the company may be something that may not seem to be necessary now, but 5 years from now it may be a valuable document to have. Those sorts of documents can be created, all these policies can be created certainly by your lawyer. I'd be remiss if I didn't suggest that as a potential resource. They can also be generated on your own largely. Take a look at what your competitors are saying. Oftentimes policies are on a website. And you can also go back to the underlying regulator, the legislative body, and take a look and see what they say has to be done in order to ensure compliance, and then use that as your base for developing your own policy. There's a huge area in employment standards. We had an earlier webinar on the employment, the hiring and firing, so I won't go into it in any great detail, and I'm also noticing we're coming close to 2 o'clock. So let me just merely say that there's a whole seminar on employment standards that can be developed. It's often ideal to have in an office procedures manual what your hiring policies are and what your operational policies are. If you've got a dress code that you want to enforce, you need to have the legal ability to point to something either in the individual's contract or in an office procedures manual that he or she has agreed to abide by in order to enforce that dress code. If you've, as a retailer, got a policy against the extension of credit, the release of tickets without full payment, if you have an employee or an independent contractor who violates that rule, and as a result you lose money as an agency, you may want to look to that transgressor for the repayment, the loss that you've incurred. Your ability to do so may well depend on whether that was established as being one of the rules of the game, because you can't change the terms of a written contract or even an oral contract after the fact. That office procedures manual is potentially something that will give you the ability to point to a document and say, there, the rules were very clear. Moving quickly to insurance, take a look at your insurance policies. What risks are covered? Are those the risks that you need to be covered? Are there any risks that you face in your business that are not insured against. If you've had conversations with your broker about what risks you want to get covered, it's possible that the broker may not have delivered on what you have asked. If a problem arises in that area, you'd love to have a paper trail to establish that you asked the broker, protect me for X, Y, and Z, and have him come back or her come back and say, yes, you're done. You're covered for X, Y, and Z. If it turns out that one of those is not covered, you'd love to have the paper trail to establish responsibility. Take a look periodically at the exclusions that you've got in your policy. Take a look at the deductible. Often by increasing a deductible, you can reduce your premium. That may be worthwhile. Take a look at the claims procedure. You know how to register a claim and by when you have to register a claim in order to make use of the insurance policy that you have paid for all these years. Have those policy numbers and contact numbers available to you at the drop of a hat, and even have them available off-site in case the insurance is a fire insurance policy and your building has gone up in flames, and taking with it those contact numbers. That whole area of factual information to be assembled, contract numbers, policy numbers, should be assembled, should be available off-site as well as on-site. Howard spoke of succession planning. I'll say very little about it. It's something that's often neglected. Does the principal of the company have a will? Does the principal of a company have a power of attorney that takes effect prior to death? The will, of course, taking effect as of death. But a power of attorney for personal care or for property may be as useful in the continued operation of the business as a will. Often in a one-director company, a one-person company, we find that the owner of the company, the sole shareholder of the company, is also the sole director, the sole officer. And that's all well and good while the company exists and while that person exists. But as Howard said, the company is different from the person. And if the person dies, the company is left with no director. It's a complicated process to replace a director. It's an easy process, and the shareholder names the director. But if the shareholder is also the same person who has died, you've got a logistics difficulty. Consider contemplating potential death of the principal of your company by having at least one more person appointed as a director, even if you have an undated resignation of that person in your hip pocket, just in case that person starts to go offline on you, and you want to get rid of that person. But at least in the event that you, as the sole owner of your company and the sole director, were to die, you've at least, in my example, got a second person who can carry on as director and repopulate the board and deal with the consequences of your death. Howard spoke of valuations. In the interest of time, because we're now just past the 2 o'clock, I won't say anything more on that. I think what I will do is to move directly to the conclusion of the hour, because we're now at 62 minutes, and invite questions. We haven't seemed to have any questions as we have gone along. I'm not so foolish as to think that that means that Howard and I have answered every one of your questions. If you have questions, we're certainly here to stay as long as is necessary. Those of you that have committed an hour to us are certainly welcome to depart and do so with our good wishes. But if you do want to stay online, do so. And whether you stay or go, do remember that there is another webinar still coming. Details can be found on the website at www.travellaw.ca. We will look forward to seeing you at that time, and we'll now look to questions from any of you that have stayed with us. Thank you.
Doug, if I might just say that you reinforced about ensuring that documentation is key at every level of the organization, and any management personnel involved at that level have to understand that without proper documentation, things aren't done.
Yeah. Giselle has a question there, Howard, and it looks like it's more directed at you. I think what she's saying is, if you're doing business with a company that's out there, how do you know if maybe that company is itself undergoing a CRA audit?
Well, that information is privileged, surely, as you had discussed. That CRA is very concerned about privacy and privilege. And just so that I understand that if You want to know that if you're doing business with a third party, that third party is undergoing an audit. That information really is not available and is only between the CRA and the individual involved in the audit.
I guess there's nothing wrong with asking. You might get an honest answer, you might get a misleading answer coming back, but there's nothing wrong with asking that other time.
No, there isn't. But one thing that's critical and has happened a number of times is certain areas of government information is available, like are the people HST registered? And there is a website that allows people to check. We've had clients where they've paid monies to contractors plus HST, and when we thought there was something unusual out of order, we checked the website and they were not in fact registered. So there are some avenues for you to look down and see if there are compliance in certain areas.
And that website that you refer to is under the general heading of CRA, I believe, and then on the left-hand side there's something for HST, and I think if you go through that, there's a series of menus that will take you to that website of registrants. Hopefully that covers your question then, Giselle. If not, please let us know. And let us know after Trudy has finished asking her question. Long one, so Howard, I'm going to want you to take this one. Taking for a long time, so it's going to take question. Okay, it's over to you then, Howard.
The audits usually range in 3 levels. There's the large audit in excess of $250 million. These are revenue-based, $250 million. There's the basic, which is from $20 million to $250 million, and the smaller audit, small by revenue CRA standards, is up to $20 million. Those are the 3 levels that CRA advises is how they tier their auditors.
Okay. Then I'm going to start to wind up. If there's any indication that there's further questions coming, I'll stop, but looks like there's one coming in, so I will stop, of our seats, and await this next question. Like he stopped typing. All right. So we will bring it to a conclusion 7 minutes after. Thank you for investing the 60 minutes and the extra 7 minutes with us. Do take a look at the www.travellaw.ca website, and we will hope to see you again at the next seminar or anyone in next year's edition. Thank you very much.